In 2014, 15, and 2017, we asked CTAs, how do they do it? CTA stands for Commodity Trading Advisor. In the United States, trading future contracts dates back to the 1850s. The Commodity Futures Trading Commission first recognized the CTA in 1974. The CTA and managed futures industry constitutes about 11.3% of the $3 trillion hedge fund industry in 2016. Historically, CTAs show profitability over an entire business cycle. The long-term value proposition of CTAs include portfolio insurance, portfolio diversification, and capital appreciation. How do CTAs generate such returns? What is the secret sauce? To find this out, we decided to conduct surveys. We collected over 110 responses, primarily from investors and managers in Europe, UK, and the United States. We asked, what do you think are the most popular markets that CTAs are trading? We ranked 82 markets based on the number of ticks. We then asked, what do you think is the most popular method for CTAs to calculate their position signals? And how often do they calculate it? The results were that momentum and trend following are the most popular methods, calculated on a daily basis. For asset allocation, survey respondents thought that equal risk weighted on a daily basis is the most common methodology. For risk control, survey respondents thought that the target volatility mechanism is the most popular method, also calculated daily. On fees, overall, 2% management fees per annum is still the most popular aggregate result. However, when looking over the past year's results, we can detect that there's a fee compression underway in the management fee area. However, the high watermark performance fee stays steady at around 20%. How do we know that these survey results actually do mean anything? We decided to apply these survey findings as parameterization in a very simple index model and to see how the results would compare with benchmark indices of the CTA and managed futures industry. We decided to use the 6 most popular markets from the CTA survey only. They are WTI crude oil, copper and gold, and the 10-year US Treasury note, Euro FX, and the S&P 500. We then roll adjusted a futures time series for each of these markets and applied a simple 12-month momentum model, looking if the price today is higher than the price from a year ago, I will go long tomorrow. If the price is lower, I will go short. To determine the weight per asset, we use the risk-weighted asset allocation method as per survey. This is to allocate proportional to the inverse volatilities of the underlying long-only markets. This is to allocate less money to markets that are more volatile and more money to markets that are less volatile. The attribution analysis shows a diversified return contribution per asset over time. As per survey results, we then applied a target volatility mechanism to control the overall portfolio risk. Other than the survey suggests, we chose 7% target volatility. Index is being decreased when the overall market volatility is high. When the overall market volatility is low, leverage is being increased. Lastly, we used the survey results on fees and applied 2% management fee and 20% high watermark performance fee on the results. We also applied the 90-day US T-bill rate as a risk-free rate to compound the non-margin cash. The dark blue line is the resultant time series. We call it the J8 CTA Index. Very much to our surprise, we found that the movements are similar to those of other benchmark indices for the CTA and managed futures industry. We found a model that offers an easy and intuitive explanation of what the CTA and managed futures industry is all about. When we look at the performance statistics of the J8 CTA index in comparison to other CTA and managed futures benchmarks indices, we see that the J8 CTA index achieves similar returns like the other benchmark indices, but at lower volatility. However, we also see that the maximum drawdown of the J8 CTA index is much higher than that of the other benchmark indices. One explanation may be that other managers use more sophisticated methods to manage the drawdown risk, at the expense, however, of higher returns. We set out to understand the inner workings of the CTA and managed futures industry better, to understand how they generate returns. By survey, we found a very simple index model which explains the majority of CTA returns. The parameterization of the J8 CTA index is purely survey-led. It uses only those methodologies and parameters deemed most popular by the survey respondents, what they think managers in the CTA and managed futures industry are doing. The J8 CTA index therefore may serve as a benchmark index from the CTA industry for the CTA industry. It may serve as a benchmark for investors to benchmark their CTA investments against, and it also may serve as a benchmark for other CTA managers to benchmark their performance against. Last but not least, because the index uses an own trading methodology, the index is replicable and investable by other market participants. That's a key difference to other CTA benchmark indices which are non-investable, because they are only tracking the performance of other funds in hindsight. We disclose the index methodology and all survey results in the index handbook for the J8 CTA index and is published on our website. This long-term research effort would not have been possible without the relentless help and support by Professor Dr. Robert Tiong Lee Kong of the Nanyang Technological University in Singapore and his assistants Dr. Chen Chen and Hui Yu Chen. Matthias Knapp of Opalesk agreed to help distribute our survey to collect more responses. Thank you, Matthias. We also want to thank AIMA for reviewing the survey questionnaire and publicizing the survey in their weekly newsletters.